Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. And I would say that prudence is not in the ascendancy at the moment. Risk-taking is. Not grievously, but it is. And so we should be careful. Well, the Mag 7 are highly valued. Those don't trouble me because they're some of the greatest companies we've ever seen, the Mag 7. But I think that the other 493 companies in the S&P 500 are selling at a PE ratio, I don't know if it's 19 today or 20 or 21, something like that. Why should the other 493, which are much more mortal, be selling at PE ratios above the historic average for the S&P over the last 80 years? So this is why I say that I think that the S&P is valued highly. We sometimes know what's going to happen, but we never know when. And anybody says this is the time or this is not the time is talking through their hat. Overpriced and going down tomorrow are far from synonymous. You know what they say, Wilfred, if you like what you do, you'll never work a day in your life. And that applies to me.
Welcome to the Master Investor Podcast with me. My guest today is a legend of the investment world. He is co-founder and co-chairman of Oaktree Capital, which manages over $200 billion in assets under management. His track record there at Oaktree speaks for itself, but he's become a legend beyond that with his investment memos, which he writes a couple per year, where he shares his considerable investment wisdom and views on the current state of play. I am, of course, talking about the one and only Howard Marks. Howard, it is such a treat to have you on the Master Investor Podcast. Welcome.
Thank you, Wilfred. It's great to be back.
And it's such great timing because you are celebrating 35 years of your memos this week, and there's a full ebook available for free on the Oaktree website, as well as your outline of the sort of best of the memos over those 35 years. And what jumped out to me from your outline, which I love, is this is a part of your job that you adore. It makes you no money. They're free for all of us to read, but you love writing these memos.
Well, you know what they say, Wilfred, if you like what you do, you'll never work a day in your life. And that applies to me.
Well, that is a phrase that resonates with me because my late father used to say it to us a great deal. And it's a big week as well because you've announced that Brookfield is buying the last minority stake in Oaktree that it didn't have yet this week. But I hope that doesn't mean you'll stop writing these memos.
No. They'll pay me as well as I have been paid to date for the memos.
Well, listen, we want to dive into them now because there's so much wisdom in there and we want to lean into all of that. And I've gone through all the memos, Howard, and I loved going back through them. And before we get on to sort of the current state of play and maybe the second half of this conversation, I wanted to dive into some of the ones that really jumped out to me today. And what was also striking, given that you've been writing these for 35 years, is the first 10 years or so, you said that people didn't really take that much note of them, which to me as a 40-year-old who's read these things eagerly for the last 20 years was very, very surprising. And the one that really changed all that for you was titled Bubble.com, January the 2nd, year 2000. Talk me through just quickly that one. What was the central premise back then?
In the fall of 99, there was a big bubble, one of the greatest bubbles we've ever seen in the stock market. It was called the TMT bubble, Tech Media Telecom bubble, but nowadays we call it the Internet bubble. And, you know, everybody assumed that the Internet would change the world. They extrapolated that to mean that an Internet stock or a stock with the name Internet in its name was worth infinity. And, you know, that fall of 99, I was reading a book by Edward Chancellor, a financial historian, called Devil Take the Hindmost, a history of financial speculation. And I was reading about, in particular, the South Sea bubble, in which England figured it would get rid of its national debt by creating a company, the South Sea Company, and giving it a monopoly to trade with the South Sea. And people went crazy over that stock, and they took off from their jobs to day trade in that stock and so forth. And as I read about people's behavior, I said, holy cow, that's exactly what's going on now in the tech stocks. And so, that was the starting point. And I wrote a memo about the misbehavior that I saw taking place in the market for tech stocks. And as you say, it came out on the first day of 2000, and it had two advantages. Number one, it was correct. And number two, it was correct soon, because if it takes a long time to be proved correct, people forget. But after 10 years, that memo made me an overnight success.
And there's so much in it. I really strongly advise people go back and read that one amongst many others. But you quote Warren Buffett in that memo. And I know he then, throughout his career, quotes you back and loves reading your memos. This is a quote that jumped out to me from Warren Buffett in that particular memo that you quote. The key to investing is not assessing how much an industry is going to affect society or how much it will grow, but rather determining the competitive advantage of any given company and, above all, the durability of that advantage. I wonder whether there's a big relevance of that today as well as there was back in 99, 2000, because with this race of investment in the space of AI, there are quite a few players competing out. Not hundreds, but it's also not like the last decade where basically Google had a monopoly on search, for example. Is that quote relevant today as it was in 99?
Oh, it's always relevant. One of the most important sayings was from Mark Twain, American author, who said, history does not repeat, but it does rhyme. There are certain themes that rhyme from cycle to cycle or generation to generation.
I wanted to ask.
And what are the characteristics of bubbles? Number one, it invariably surrounds something new that triggers the excitement, gets people going. And since there's no history of it, there's no indication of what its limitations might be. And then people get excited about the new thing, and they assume that it will change the world, and then they assume that that will result in profitability, which is not always a strong assumption. And that was one of the comments I made in the memo about e-commerce. Then they assume that the incumbents will succeed, whereas they may be replaced. And in the extreme, they assume they'll all succeed, which may be unlikely. But, the opportunity to buy the stock in each one looks like a lottery ticket that could pay off in millions. So these are some of the threads. And Buffett said 25 years ago about the internet that the internet will certainly increase efficiency, but will it increase profitability? Which is to say, for example, what if all the companies in a given industry get AI? They compete to use it. They all put it to work. It increases efficiency for all of them, but they compete for business by cutting their prices. And that eliminates the unusual profitability of that industry. So, what he's saying is change the world and make a lot of money don't necessarily mean the same.
As you mentioned, the timing of that January 2000 note, bubble.com, was prescient. It made you a huge success. But in one of your later memos, November 2001, titled, You Can't Predict, You Can Prepare, you also outline, I guess this thing is fair to say, Howard, in that one, the central premise that it's impossible most of the time to correctly call the moment when something will come to an end, but that you do believe in cycles more broadly, and you can try and establish where you are in a cycle. Is that fair?
Exactly. I always hearken back to my way of saying things. But number one, there's not a word in bubble.com of prediction. It's only observation of what was going on at the time. And so what I say is we never know where we're going, but we sure as hell ought to know where we are. And where we are influences, or you might even say determines where we're going to go. But it's sufficient, and maybe all you can do, to say what's going on today, what are the implications for tomorrow, probably. Then the other thing, you mentioned timing, we sometimes know what's going to happen, but we never know when. And anybody says this is the time or this is not the time is talking through their hat. So the point is, what I call it is taking the temperature of the market, assessing what's going on, drawing inferences from that, and perhaps conclusions, assessing behavior, assessing the pricing of securities, and assessing the risk that's present. But we never know. I mean, one of the most important things for everybody to realize is that overpriced and going down tomorrow are far from synonymous, because things can be overpriced and then become more overpriced and then highly overpriced and then extremely overpriced and then bubbles. Mm-hmm. And it can take years. And if you see something that's overpriced and bet against it heavily enough, you can get carried out. And that's why your countryman, Lord Keynes, said the market can remain irrational longer than you can remain solvent. Mm-hmm. Because irrationality can go on more and more and more and to greater and greater extremes. And betting that rationality will prevail in the short run can be fatal, absolutely fatal.
And in terms of the cycle right now, I wonder, particularly in the last couple of weeks, and some of the big bank CEOs were commenting on this in their reports earlier this week, there have been a couple of quite high-profile defaults, maybe not massive defaults in the US, Tricolor and First Brands. What do you think of that? Does that tell you we are late in this cycle one way or another, or not?
No, not at all. Not at all. There are defaults all the time. One of my lucky breaks was being asked to start Citibank's high yield bond activities in 1978, which was the beginning of the high yield bond world. And one of the things about investing or life is that it's great to be in at the beginning. So I've been involved in high yield bonds. It'll be 47 years next month. There have been defaults every year. So the existence of defaults in itself is not a big deal. Now, in the case of those two, there is somewhat more significance than the usual default, because they both probably, well, let's say, I'll try to stay out of jail here. They both may have had something to do with misbehavior on the part of the management, and they may have been examples of inadequate due diligence, because somebody bought those bonds or those loans and held them. So that's significant. And one of my heroes, John Kenneth Galbraith, the American economist, used to talk about a good bezel. He was talking about embezzlement. He says, well, it's time for a good bezel. And the truth is that when the economy's doing well, the markets are flying high, the investors are optimistic. When the investors are more afraid about missing out than they are about losing money, that's the climate in which a good bezel can take hold. And, I spent my first 16 years at Citibank, and the bankers have a saying that the worst of loans are made in the best of times, for the reasons I described. And because the lenders compete to make loans, and when the going's good, they compete aggressively. That's when mistakes slip through. Mm-hmm. This is why I believe that it is the behavior of the participants who determine the level of risk in the markets. And, today, I mean, we've had 16 positive years. There hasn't been a bad year in the last 16. There were 2 down years, but not too bad and easily recovered. There has not been a prolonged stretch of decline. So risk-taking has been rewarded. Caution has been penalized. I would say that, it has made people feel that it's more dangerous to be out of the market than in. To turn down a loan could be dangerous than making a loan. These are all bad lessons. And it's not the worst I've ever seen. It's not as bad as February 07, for example, but it's certainly on the incautious side. You quote Buffett to me, I'll quote Buffett to you. Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. And I would say that prudence is not in the ascendancy at the moment. Risk-taking is. Not grievously, but it is. And so we should be careful. And when I say careful, I try to always be careful. So when I say careful, I mean more careful than usual.
that night.